Good day, ladies and gentlemen, and welcome to the Art of Entry and Exit Points. Now, this is our second half of the class because, as I mentioned in the first half, it became too long to put into one presentation. So I broke it in half by entry points and exit points. So the first video presentation is on entry points, and this is part two, and we're going to be dealing mostly with exit points or how to exit a trade. Now, I'd appreciate it greatly if you would click on the subscribe button and hit the bell icon down below and allow me to send you updates when I've launched new presentations. So I would appreciate if you would subscribe. I promise you, we won't inundate you with emails. We won't even ever send you one. So finding an entry or an exit point for your trades is one of the most important skills to master. These quick trade tips will help you determine when to enter at the best possible price, enabling you to your trades to capture the most profit. But in reality, once you've entered, it's a complicated process, but it's a simple process. But the real trading doesn't begin until you've actually entered a trade. So first you're making a decision. Okay? But lots of times you'll set up a limit order and your price will never even be reached till your order's never executed. So your real trading doesn't actually begin until you've actually entered the markets. So the question is, you've entered the market, you've put your stop loss, your target, all in place before you ever entered your market. The question is, do you know when to leave? Because we all know that there are two steps in every trade. When we open a position and then when we close the position. But we very often get confused on the first part, often to the exclusion of the second part. Here's one thing though, you don't make any money by opening a trade. That's actually when you put your money at risk. So keep that in mind. Until you open a trade, you have nothing at risk. But once you open your trade, you're entering the great world of risk. Okay. It's not till you close your trade that you're leaving the risk behind and actually seeing profits. So whether or not you make money actually depends on when you close the trade. You can open the trade at the perfect time, but you won't see a cent of profit from it unless you exit at the right time. So when you close your trade, you need to have an exit strategy. And it's just as important as when you have opened a trade. Now granted, you set limit orders, you put stop losses. That's to protect you from risk. The market moves against you, or to grab you the profits if the market reaches your target. But there's lots of stuff in between. So another possibility is that you could use one strategy to determine entry points and another to determine exits. This leaves you with a really unbalanced trade. Huge risk on either side, since each strategy will have different relative risk. However, closing a trade is different from opening one, which means that the kind of risk you are taking when deciding to close is different. An open trade has the option of losing out on potential profit by closing before the market is turned. There is a vital difference between a trader who has an exact exit plan and one who has none at all. There's a lot of traders out there, like I said, who set their target point, their stop loss, their entry point, and come back an hour later to see what happened. Okay, managing your trade is so important, and managing your exit. Yes, if you come out, if you open a trade euro 110.50, set your limit at 110.90, and it reaches 110.90, yeah, you made a nice trade. You picked up 40 pips. You made some profit. But what happens when it gets to 111.05 and you could have stayed in there till 111.05? Maybe you should have moved to a trailing stop loss. Maybe you should have closed half your position in big profit and let the other half ride. What is your strategy? What is your exit? Not what is your exit point. What is your exit strategy? Exit planning covers a stop loss strategy to get out of bad trades, a profit protection strategy to exit winning trades, and another strategy to save your neck in case of unexpected risks. You'll need all three tactics in every trade because anything can happen once you hit that order button, once you've entered the great game. So it's easy to get into the market. There are so many different techniques. But what about getting out? There is a vital difference between a trader who has an exit plan and none at all. It doesn't matter if the positions are in profit or going down in flames. As a trader, you need two exit strategies, one to handle profits and another to handle losses. And when dealing with profits, you also need to know how to protect them. Because again, your stop loss is there to protect you if the trade doesn't do what you thought it was going to do or the market moves against you. Okay. But that stop loss isn't permanently in stone. This is why you have the ability to change your stop loss. You have to constantly be looking and seeing what the market's doing. And if the volatility is contracting or the profits, the trade has moved up, you can move your stop loss higher. Okay. And this is it. You have to understand what you're doing. So therefore, exit planning covers a stop loss strategy to get out of bad trades, a profit protection strategy to exit winning trades, and another strategy to save your neck. Traders focus a lot of their energy on spotting the perfect time to enter a trade. While this is important, it is ultimately where traders choose to exit trades that will determine how successful the trade is. Now, we should understand that there are only two ways to get out of a trade: through loss or through gain. Although it might seem obvious, the way to include both profit-taking and stop-lossing strategy will determine the fate of your trade. A take-profit order, also known as a TP, is a limit order that specifies the exact price or the specific point level at which you want your broker to close your position. Usually take profit orders are used by short-term traders like you and me that are interested in taking advantage of precise volatile conditions in the market. Take profit orders are placed after identifying the price target, which can be found using technical analysis. As a trader, you can add take profit orders with most brokers, but there are some outliers that don't offer this option. Be careful. If you're dealing with a broker who doesn't order you multiple order entry and order exit strategies, you need to find a new broker. You should be able to put take profits, stop losses. You should be able to put OCOs, good to the end of the day. There should be multiple order type choices so that you can exact the strategies that work best for you. It's just a matter of a set of information and instructions given to a computer. Profit-taking orders are always set above the current asking price when you're buying a pair or below when you're selling a pair. It could be fixed at a percentage of your position or a number of pips or at an exact price. A stop-loss order is kind of a command which instructs your broker, or technically the platform, to close your position when the unit touches a specific price or when an amount of losses is reached. Stop losses are always above the current asking price on a buy or beneath the current asking price on a sell. Now, let's say hypothetically you go into that euro trade at 110.50. You see the volatility in the markets and your risk management, and you put a stop loss at 110. You've got your profit, your take profit at 110.90. Okay. I haven't done any stop loss or risk management calculation, but we're using these figures. We're using 110, 110.50, 110.90. Now you execute your trade at 110.50, and the price ticks up to 110.52, 110.54, 110.56, 110.60, 110.62. Well, your stop loss is still sitting there at 110. Well, isn't that kind of stupid? The price is moving up. Why would you want to then expose yourself to the continued loss of 110. Why wouldn't you move that stop loss up and up and up? And why wouldn't that stop loss when you hit 110.65 be at about 110.35? Or why wouldn't you move your stop loss up to 110.55 when it hit 110.70? Guaranteed profit. Small profit, but guaranteed profit. Okay. Or what about a trailing stop loss that as the asset keeps moving up, it'll pull that stop loss higher and higher with it. Eventually, your stop loss is way into the profits. And then guess what? You can also move your limit. You can have lots of things like closing half of your position at your limit and letting the other half ride with that stop loss so close that if the price ticks against you, it'll close out in profit. Now, there are three types of stop loss orders: good to cancel, GTC, day orders, and trailing stops. GTC is an order to buy or sell a share or an asset at a fixed price that remains active until the trade is completed or until the trader cancels it. So it's just good to cancel. You set up a limit order at this price. Now, the problem is, if you set up a limit order at a specific price with a stop loss and take profit, and it doesn't get reached today, it doesn't mean it goes off the boards. It's going to stay there. And if 3 days from now, that price gets reached, it's going to execute that trade. When the volatility is different, the target point's different. So unless you go and close out that open order, it's not an order, it's not trading, but close out that request, that order could get executed anytime down the road. A day order is a request that expires at the end of that trading day. So all platforms offer GTC, GTD, good to the end of the day, good to the end of the week. You also have ones that will actually let you set the date and time in which you want to cancel off that possible order. Now, trailing stop orders set the trigger price at a fixed amount of pips or a defined percentage below the market price. A trailing stop is dynamic as it changes if the position moves in favor of the trader, but remains static when the market comes against the position. So in other words, we opened a position at 110. We had our stop loss at 10. Markets move up 110.50, 110.60, 110.70. Well, if you were using a trailing stop loss, that stop loss would have moved up each time. So by now, the asset was trading at 110.70. That stop loss should have moved up to 110.30. Okay, it doesn't fall down from there. So if the market falls down to 110.30, you get stopped out at 110.30, and you don't have anywhere near the initial risk you had. But you keep the same distance because you're at 110.70 to 110. Let's calculate my 110.20. So you only had that 5-point risk. So you always stay at the same amount of risk, but not the same amount of capital. So if the markets then turned against you, it would stop you out at 110.20. You would have lost a lot less than you had originally entered the trade for. So although stop loss is a kind of order you never want to execute, you should include it along with your profit taking in your strategies. It helps lock in profits while limiting potential losses. Every trade should have a stop loss. But you know what? Every time you get stopped out of the market, you may say, fine, I got stopped out. The market's moved against me. I added a little bit of risk. You should be kicking yourself in the butt because you've left it up to a computer to close your trade instead of looking at what's happening in the markets and maybe moving your stop loss or closing your position at an earlier time. Now, there's many different types of strategies we can employ. We can use scaling exit strategies. For a scaling exit approach, raise your stop to break even as soon as the new trade moves into profit. This can build confidence because you now have a free trade. Then sit back and let it run until the price reaches 75% of the distance between risk and reward targets. You then have an option to exit all at once or in pieces. Now, this is my favorite trade. This is how I trade most of the time. This decision tracks position size as well as strategy being employed. For example, it makes no sense to break a small trade into even smaller parts. I mean, if you're trading $200 worth of the euro and it's moved in your favor to sell $100 worth of euro at this price and stuff. There's no difference. Close your position. So if it is more effective to seek the most opportune moment to dump the entire stake and apply the stop at reward strategy. Large positions benefit with a tiered exit strategy, exiting 1/3 to 75% of the distance between risk and reward, and the second third at the target, placing a trailing stop behind the third piece after it exceeds the target, using the level as a rock bottom exit if the position goes south. Over time, you'll find the third piece is a lifesaver, often generating substantial profits. Like I said, we saw the euro, and you told the computer to take your profit at 110.90. Well, it moved all the way up to 110.90. It shot all the way up to 111.40. Well, if you had followed this strategy, sold off, you would have still had 1/3 of your position. And when it hit 110, 111.40, you would have booked that 50 pips extra profit. It would have been beautiful. And you had virtually no risk because you had been moving your stop loss and selling each position you sold, you book profit. You book profit in the first 25%, you book profit in the next 50%. Okay. And so you were in a profitable situation because also your stop loss was higher than your entry point. So even if it nosedived after it hit 110.90, okay, you still had already booked your profit. The most it would have done is close out your position, maybe at your entry point or a little bit higher. So think about these things. Now, there's other types of strategies like moving average, trailing stops. It's been long known that a moving average can be an effective tool to filter what direction a currency pair is traded. The basic idea is that traders look for buying opportunities and selling opportunities. Okay, I use moving averages, red light, green light, to just as environmental or informational. I don't use it in my stop losses. I also don't use it in entry and exit points. But there are traders who do use moving average, trailing stop losses. And your moving average will move up along with your stop loss will move up you will move it up along following the moving average as it moves up or down, depending on which direction you're going. There's also strategies based on volatility. As volatility contracts and widens, and you can use indicators such as ATR. The greater the ATR is on a given pair, the wider the stop should be. This makes sense because a tight stop on a volatile pair could get you stopped out too early. But this is really a decision for placing your stop and not placing your exit strategy. So, in summary, remember that Forex trading is more than just getting good entries, as the success of a trade will ultimately depend on where traders exit their positions and how they exit their positions. New traders can build confidence in trading by having a trading plan that implements a precise exit strategy to close out their trades. Trading exit strategies are just one part of a complex Forex strategy. Now, price has an uncanny way of respecting not only pivot points, but also Fibonacci ratios. So they're a good way to use to manage your position. Because remember, as I said, you need to manage your position the entire time. You've set up a trade. You've told the computer you set up a limiter, told the computer to buy at this price only today, to close you out at this price if it's executed, if it goes below, and you've told the computer to take your profit at this point. Okay. Now, managing it, you could put a trailing stop loss. You can continue moving up. You can continue selling off positions. You are managing your position throughout the trade. You've set the barrier here, the barrier there, the entry point here. Okay, those are the basic fundamentals. It's managing your position. Because once you've actually entered a trade, the real trading begins. So many people spend so much time on these complex entries strategies and trade decisions. They use all these indicators, oscillators, patterns, and God knows how many lines they have on the chart. Don't only forget that the trading doesn't really begin until we actually have a trade. So the question is, do you know when to leave and how to leave with your profit intact? So thank you very much for joining us. Have a great trading week. And if you didn't see part 1 on entry strategies, please stop over and see part 1. And thank you very much for being part of our Forex family. Bye now.